Welcome to CoreLogic's monthly housing market update. This month we look at the rate of capital gains up to the end of September 2016, and we examine some of the factors that have affected housing market conditions across the different regions. CoreLogic's September data showed a further 1% rise in dwelling values across the combined capital cities of Australia. That's following a 1.1% increase over the month of August and a 0.7% rise in July. The quarterly rate of growth increased to 2.9% across the capitals, which at face value is a strong rate of capital gains, but well below the pace of capital gains a year ago, when CoreLogic's Hedonic index was up by 4% over the September quarter. The strong September quarter reading for home values was pushed higher by a 5% surge in Melbourne dwelling values and a 4.5% increase in dwelling values across Canberra. Sydney, where growth in dwelling values has generally been nation-leading over the growth cycle to date, showed the third highest pace of dwelling value growth over the quarter at 3.5%. Highlighting the diversity in the market, 3 of the 8 capital cities recorded a fall in dwelling values over the quarter, with the largest decline in Darwin, where dwelling values were down by 4.5%. With dwelling values continuing to rise over the third quarter of the year across most of the capital cities, there's likely to be more focus on the factors that are driving growth across the housing market. Low mortgage rates are likely to be one of the factors providing some upwards pressure to housing demand. Mortgage rates have been cut twice now during 2016, with the most recent cut in August being the 12th reduction in the cash rate since November 2011. Australian borrowers haven't enjoyed mortgage rates this low since the early 1960s. Investors are also contributing a higher than normal level of demand to the housing market. The latest data from the Australian Bureau of Statistics shows that investors currently comprise 48% of new mortgage commitments. While that's down from a record high of 55% last year, it still indicates that housing investment is providing a higher than normal level of demand. The value of investment mortgages has once again been trending higher since May of this year. Low stock levels are likely to be another factor at play driving dwelling values higher in some cities. Low stock levels tend to create some level of urgency in the housing market, with vendors holding more leverage over buyers at the negotiation table and buyers generally having little time to undertake their due diligence to make an informed and strategic purchase decision. Nationally, stock levels are approximately 2% lower than they were a year ago, but they're now starting to show the normal spring ramp-up, which will provide a timely test for the market's resilience to higher stock levels. The shortage of stock may also be contributing to lower auction volumes that have been a feature of the auction market this season. Despite auction clearance rates surging higher over the past few months, auction volumes have been tracking about 16% lower over the first 5 weeks of the spring season. Sydney's auction clearance rate's been consistently above 80% each week during spring, and the Melbourne clearance rate's been averaging in this high 70% range. Low stock levels are also contributing to a downturn in transaction numbers. Year on year, transaction numbers are down 11% nationally, with falls recorded across most of the capital cities. While lower transaction numbers are likely to be related to a reduction in housing demand in markets like Perth and Darwin, where dwelling values are falling, in stronger markets like Sydney and Melbourne, where year-on-year sales are down by 18% and 20% respectively, lower turnover is likely to be more attributable to the low number of homes that are currently available for sale. Importantly, there's likely to be some level of upwards revision to transaction numbers as the record number of off-the-plan sales move through to settlement. Additionally, other factors such as affordability constraints, tighter lending policies, and high transactional costs are also contributing to less housing market turnover. Adelaide's housing market saw dwelling values rise by 2.6% over the September quarter, taking the annual growth rate to 6.5%. That's the highest pace of annual growth since August 2010. While growth was skewed towards detached housing over the September quarter, over the past 12 months, there's little difference between the housing types. House values are up by 6.5% over the past 12 months, while unit values have increased by 7.1%. Transactional activity appears to be under some subtle upwards pressure, with year-on-year sales increasing by 3.3%. The reasonably strong housing market results across Adelaide may come as a surprise for some, considering there remains some level of economic uncertainty across South Australia due to the wind down of the local manufacturing sector, as well as soft commodity market conditions. Overall, the headline readings from the housing market remain strong. Dwelling values continue to rise across most capital cities. However, there remains a great deal of divergence between the regions and between the product types. Sydney and Melbourne continue to show a strong trend for capital gains, albeit at a slower pace than a year ago. Growth conditions appear to be accelerating in some of the smaller markets like Hobart, Canberra, and to a lesser extent in Adelaide. Brisbane may not be far behind the accelerating trend, with interstate migration into Queensland starting to pick up. But Perth and Darwin markets continue to retrace on the back of weak economic and demographic conditions. Policymakers and regulators will be monitoring the housing market closely. The most recent statements from the Reserve Bank seem to indicate a less comfortable view on the housing market than previous months, citing a recent strengthening in some markets along with rental conditions that are tracking at the slowest pace in several decades. A broad re-acceleration in housing market growth rates may make it more difficult for the Reserve Bank to lower interest rates further for concern of overstimulating housing markets. Despite the ongoing strength in the housing market, at least at a macro level, there are plenty of headwinds that are likely to limit the pace of capital gains even if interest rates do move lower. Banks have tightened their lending policies and generally require larger deposits. Supply levels are at record highs and they'll trend higher over the coming months as approvals move through to the construction phase. Rental yields are at record lows, which may start to act as a greater disincentive to investors, particularly in markets like Sydney and Melbourne, where the gross yield on a house is now below 3%. Housing affordability is becoming stretched, particularly in Sydney, where dwelling values have substantially outpaced household income growth. Additionally, offshore investors are now a smaller component of housing demand due to stricter lending policies and more scrutiny around foreign buying rules. Despite these headwinds, with conservative asset classes like cash and government bonds offering low returns and share markets remaining volatile, it's likely that housing investment will continue to be a popular option. Although gross rental yields are at historic lows, they remain higher than the rates for cash deposits and are quite attractive when you factor in the growth in home values as well as the yield, especially if investors are using larger deposits. It certainly is interesting times across the housing market, and it's certain we'll continue to see a great deal of interest in the performance of the housing market across Australia. For more analysis and research about Australia's housing markets, make sure you visit our website at www.corelogic.com.au.